Yes, it was a good year for the trust, despite a sort of bit of a wobble around sort of the Brexit referendum result, where our combination of concentration on 250 mid-cap stocks in the UK and lack of gilts did cause a little bit of turbulence at that time for us. By the end of the year, a lot of our mid-cap companies had recovered very nicely after a sell-off post-Brexit, and the overall return for the year was ended up being 19.6% on a net asset value basis and over 20% on a share price basis. What was particularly pleasing, I think, over that period was that returns came from a very wide range of the assets that we invest in. So, already the UK equity portfolio gave a very satisfactory 18.5% return. Overseas equities were the star performer, but they were very much sort of benefiting from the weakness in sterling over the period, and they gave a sort of 25% return. But we also had very good returns from our fixed income portfolio, where we're underweight, but the positions that we have performed very well in very specialist areas. And the specialist assets also performed well, giving a return of 15%. So that was particularly, I think, satisfying that the contributions to the overall return came from a very wide range of assets. In terms of the dividend front for the trust, we increased the dividend by 3.5%. That was ahead of inflation, which is our remit to grow dividends ahead of inflation over the medium to longer term. And all of the sort of returns that were achieved were done with a much lower level of volatility than the pure equity market, something like 20% lower volatility. So all in all, it was actually a good year for the trust.
So over the last 12 months, we've seen equity markets move higher. I think that's really because we've seen an improvement in the economic picture. And we started to see that actually around the second quarter of last year, when we were looking at the OECD Global Leading Economic Indicator, which was starting to turn up. And that to us was a sign that we were entering a period of improvement for the global economy, which is indeed what we've actually seen. And as equity markets have moved higher, that means that valuations have become slightly less compelling, and we've therefore been reducing our equity position. So if you went back a year ago, you'd see that we were around 5% overweight, and we've gradually been reducing that over the last 12 months, so that at the end of May we were a 1% overweight position. That is the major change. Where's that money gone? A little bit has gone into some of our fixed income holdings. We've seen a bit of an increase in our specialist assets, and our cash weighting has probably moved up a little bit. So those are the main changes.
Yes, we've made a couple of additions this year to the UK equity portfolio, one of which was One Savings Bank, which is effectively a challenger bank operating mainly in the south of England, outside of London, offering buy-to-let mortgages to the sort of private landlord market. We like the valuation of the company. It's one of the lowest cost, if not the lowest cost operator in the country, and it came on a very attractive yield. Another new position in the UK equity portfolio has been Conviviality. Their main business is the operation of the bargain booze, convenience stores, mainly in the north of England, but we think there's a great deal of opportunity for them to expand outside of the north. But also they're one of the main distributors to the on-trade of beers and other sort of supplies, which we think is again a very interesting and fragmented area, which gives them great opportunities to grow. Another new investment that we've made fairly recently has been in PRS. That stands for Private Rented Sector in the UK, which has traditionally been an area which has been dominated by sort of individual private landlords. We think there's a great need for housing formation and a new sort of stock of rental properties. They're concentrating mainly on the family market with new houses, and the potential returns that they're targeted for the company look attractive, in a yield for the first year of 5%, rising to 6% and an overall potential return of 10%, which we think looks attractive.
Well, if you look at the structure of our trust, we're investing in equities, bonds, and what we call specialist assets. And if you take out the specialist assets, then you're looking at a fairly standard bond equity balanced fund. But by adding in specialist assets, that makes the trust genuinely more interesting. What are specialist assets? Well, specialist assets are fairly simple investments. They could be real estate investment trusts. They could be infrastructure funds. They could be asset leasing vehicles, which are fairly simple to understand. But what we're not doing within specialist assets are we're not investing in sort of complicated structures, whether that's it might be hedge funds or derivative strategies or structured products. We're really trying to keep things fairly simple and getting a nice balance between too much simplicity, but also at the same time ending up with a portfolio that isn't too complicated. You can look at the structure of the portfolio and you can understand really what we're investing in. So hopefully that is we're able to enhance the risk return profile of the trust without doing things that people simply can't understand.
Yes, so as you say, the discount control mechanism was introduced last year, and it was very much introduced to provide greater liquidity to the shares of the company, particularly for large investors, but also to eliminate, I think, the fear that some investors have in investment trusts that they will see big discounts open up, which can happen from time to time. I think what we've done effectively with the introduction of the discount control mechanism is largely removed that risk. So we would expect the company to issue shares on a very small premium to net asset value and buy back shares on a very small discount to net asset value, therefore effectively controlling that sort of range of divergence away from the underlying net asset value.